I've never actually spoken to someone whose systematic strategies manage 159 billion.
It started with two guys and a Bloomberg station in a garage.
My guest this week is Jason Su. He's the co-founder of Research Affiliates, a systematic asset management firm whose strategies use a smart beta approach to managing $159 billion. He now runs Rayliant, another firm trading emerging markets.
For a lot of investors, they really don't know how much they have in stocks, how much they have in bonds. And those are difficult choices. And so we should create a portfolio solution that make those choices for them. When you think about what compounds your wealth more efficiently, you want to look at the nutrients. Right? Are you getting your minerals, your vitamin D's, your proteins, your good fat? And that's what factors do. They basically say, do you have these good long-term building blocks for long-term portfolio health? Why our edge is a bit more robust and consistent is the quantitative science. You could say it's fairly new, and that gives you an opportunity, right? Because you don't want to go to where it's super crowded. You're more likely to still have an edge because this field is still young-ish.
Even a guy like Jim Chanos, who used to be worth $6-7 billion, one Tesla short and he's no longer a billionaire.
Some of the best poker players could lose big. They could make the right bet on a winning hand, but someone draws a better card on the river. What are you going to do about it? So luck plays a big part. The sustainability of an industry is entirely predicated on the value creation. The Citadels and Millenniums, they're a bit of a sideshow. They create some billionaires, but again, these market makers, what is the value they generate for society?
Jason, thank you so much for doing this. I've never actually spoken to someone who's founded a firm whose systematic strategies manage $159 billion. Tell me, what was it like starting Research Affiliates?
Ethan, like every startup, especially the Californian startup, it started with two guys and a Bloomberg station in a garage, right? We had high hopes, high aspirations, but I would say the success was significantly, larger than our wildest imagination. At the time, we didn't know where it was going to go. Right? We hoped it would, but we really didn't know. So it was, two dudes, dreamy of a spectacular future, but I would say wildly surprised by what it turned into.
And so I guess I want to hear a little bit, towards, you're at the start of your journey in, let's say, ETFs and systematic investing with Research Affiliates. What were some of the first products that you started offering? What value did you want to provide that you didn't think currently existed in the markets?
So, like every startup, we tried many things and had many pivots, but let me sort of skip over all of that and talk about what was our first successful product. So the first successful product we brought to market was in 2002. It was a product we created jointly with PIMCO. And again, PIMCO back in 2002 is nothing like where it is today, right? Back then, it was just a little over 100 billion. I mean, still quite large. But, today, PIMCO is like nearly $3 trillion shop, right? So it was, you can call it still the early days of PIMCO and early days of Bill Grow. So we're lucky to have struck up that partnership. And we launched what is really a multi-asset fund. We call it the All Asset Fund. It was a very unique product, both for PIMCO, but also for the marketplace, right? Because the marketplace at that point in time in 2002 was, you were active equities or you were active fixed income. Right? And then, you sort of didn't cross over. Those were two main buckets and you stayed in your lane. The all asset said, look, for a lot of investors, they really don't know how much they have in stocks, how much they have in bonds, what type of stocks. Right? Those are difficult choices. And so we should create a portfolio solution that make those choices for them. Right? That says, should you have more stocks? Should it be more U.S. or more emerging markets, more large cap, more small cap? How much should you have in bonds? And should it be just cash money market? Should you, bet on rate decline and then bet on really long dated bonds and benefit from the capital gain of fallen 30-year rates? Should you take some credit risk and buy high yield? These things are very, very sort of institutional in nature in terms of getting them right. average retail investors can't do that. So why don't you create a fund product that'll do that? So that was kind of the genesis of the All Asset Fund. And as it as we suspected, but we're lucky because we had other hypotheses before that didn't pan out. That became quite popular. A lot of financial advisors, a lot of retail investors said, "Look, that is a pain point I have, and I'm really glad there's a product that solves this."
No, for sure. And I think that so often a lot of retail investors, they don't have access to the same level of sophistication that a lot of the institutional guys have. And so I think especially back in 2002, launching a product like that must have been extraordinary for a lot of people. One of the things I was, when I was doing research on research affiliates and you is, you being a pioneer in what's called smart beta. And so I'd love to hear it from you. What is, I guess for our audience, in simple terms, what is smart beta? And how exactly did you stumble across it, get involved in it while you were building the powerhouse that is research affiliates today?
So to understand smart beta, you need to first understand what I affectionately call bulk beta, not dumb beta, but bulk beta. What is bulk beta? S&P 500 to me is bulk beta. Right? It's a really good product, and when it's done cheaply, it's a very efficient product. Right? It's not easy to beat the S&P 500. But the S&P 500, how is it built, right? It's built by giving the biggest weight to the biggest stock, right? Today, that would be NVIDIA, right? And before it was Apple, and before it was Microsoft. So if you understood how bulk beta, how S&P is built, you kind of start to wonder, okay, this might work fine. The market's very efficient, right? NVIDIA, great company. That's why it's the biggest cap company. And so you put more money in it, maybe a good idea. But if you contemplate like going to more inefficient markets where the biggest stock at the time could be the most overvalued, most overhyped story stocks that will actually disappoint in the future, then cap weighting, right? Giving the most weight to the most hyped stock is probably a bad idea. And so in a less efficient market, right? Something not as efficient as the US, cap weighting is actually a very bad construct, right? Constantly giving the most weight to the most hyped stocks and constantly giving no weights to like the sleeper stocks, things people haven't discovered. They haven't, attracted a lot of eyeballs, a lot of enthusiasm, not on TV. And so cap weighting is almost the opposite of what you should do in more inefficient markets. And of course, again, taking you back in time a little bit, in 2002, we just came off of what? We just came off of the tech bubble. And people at the time would not say, oh, the US is a very efficient market, right? Because they are smarting from, buying Yahoo's, buying, Cisco, companies that they thought were going to dominate the world. And all of a sudden they've fallen 80%. And so they go, okay, we were maybe a little taken by all the hype around these internet stocks, and clearly cap weighting hype is a bad idea. And so we launched that concept, smart beta, is a better way to weight a index in, start of 2004. The research work was done and is quite well read, well received in 2003. It's a theoretical concept, but the product came to be in 2004. We call it fundamental weighting. It's just not using cap weighting, using something that's a bit more fundamental, it's a bit more related to fair valuation. And that became very popular. Now, historical context matters, right? Because they came off of a time period where markets were very inefficient and cap weighting was a very bad concept. So that was the start of smart beta. And to understand why it's smart, it's really about, well, bulk beta doesn't work very well when markets are very inefficient.
For sure. And I think this is a great time to transition into, you started research affiliates, and I know that, more recently you've transitioned into spinning off Rayliant, which is the, correct me if I'm wrong, but the Asian division of research affiliates. You spun that off and launched a bunch of products there. And one of the ideas that I find very interesting when I was listening to your podcasts, was this idea of taking, so for historical context, you launched the research affiliates fundamental index, correct me if I'm wrong, yeah, as you said earlier, sorry, off the back of the inefficiency that came about in the US. And one of the things that you've said in interviews, is that the Asian markets tend to be far less efficient than that of the US. And I guess before we dive into the products that Rayliant offers, I guess I'd like to hear why the Asian markets tend to be less efficient. What are the drivers of that inefficiency?
So, um, you know, the biggest driver of market inefficiency is really the quality of the participant in that market. When you look at the US, most people would say the US market is one of the highest quality, most efficient market. Really, the statistic that they're pointing to, or what's implied by that, is historically, at least the last few decades, the U.S. market is almost purely institutional, meaning it's not a retail individual day trading at home that's driving the trade volume, that's driving prices, right? It's the big pension funds, the big sovereign wealth funds. It's these big mutual funds with their professional managers. It's the hedge funds. So very well informed, well resourced, highly analytical portfolio managers who are competing against each other and in that competition creating market efficiency. And so they tend not to create a lot of speculative bubbles where a Ponzi scheme gets hyped up, right? But once you leave the US, most markets, and especially Asian markets, um, there's just a lot of day trading, a lot of speculation. You can call it culture. I would say it's a combination of Asian investors save a lot. And when they save a lot, clearly, they got to invest, right? They invest a lot in real estate, but they also then invest a lot in the stock market. And it's just cultural that when they invest, they tend to do it themselves. It's a DIY, right? They want to save management fee. They don't want to pay for fund fee. So they DIY. The result of it's just a lot of not very skilled, uninformed day trading. And that can often lead to Ponzi schemes, fraudulent companies that run up in prices and then crash. So those markets are lower quality because the price discovery is not done by very professional trained portfolio managers. So that's what I mean when I say those markets are less efficient.
I see. And I guess, what opportunities arise for product offerings as a result of that inefficiency?
So in those markets, and let's just take China, right? Because China is very big and a lot of people pay attention to it. So it's sort of a good example that probably resonate with a lot of people. Like the China market is less efficient. It's because most of the trade volume, I think I saw statistics that, at least up until 5 years ago, it's 85% of that market's trading activities are conducted by retail individuals. So not super well-informed, well-sophisticated participants. So they're just big volatilities, big swings, patterns that a hedge fund could take advantage of. And in those markets, what you realize is if you are a professional money manager, you have access to information, you can analyze it correctly, you're going to make the right decision because the other side of your trade is constantly making the wrong decision. So you can just imagine, when you're competing, you don't want to competing against people who are as good as you are, right? You want to compete against people who are significantly less resourced and less skilled than you are. And so in those markets, you do see active managers creating quite consistent, quite large alpha, which is something you don't see in the US. Right? And it's not because, active managers are more skilled in China. No, active managers are really skilled in the US, except they compete against each other, so no one has an edge. Whereas a active manager, he doesn't have to be super good, but he can win because his competition is very unskilled. And so that's really where, the claim that there's more alpha, trading in Asian markets, trading markets like China, it's very retail dominated. Active management works better. Yeah, that's the reason. It's really about there's a lot of alpha reservoir, right? Uninformed individuals supplying alpha.
100%. And I guess the gambling analogy would be sitting at a table with a bunch of chumps versus all these MIT math graduates. I think that's the analogy that really sticks when you're thinking about competing within the markets. And I can 100% agree. I mean, you look at the US, even the retail investors on X can be quite sophisticated. The amount of research they can do is up there. And I feel like they've created this culture where the best ideas are shared in public. You know, we have Bill Ackman going out giving talks. We have, top hedge fund guys just going out giving talks. Warren Buffett will spill all of his investing secrets. I mean, you can look at the portfolio of Berkshire Hathaway. It's a publicly listed company. And so I think those cultural aspects also play into this idea of, competing against really sophisticated investors. I guess I'd like to hear specifically about Rayliant's product offerings. What specifically do you provide in Asia? And you know, I'm I guess I have another question about that. I'm from the Philippines, and when I look at the Philippine markets and I contrast them to the U.S. or even to Europe or to China, and maybe this is another question that's difficult to answer at the same time as the first, but I look at the liquidity in the markets, and I think our daily volume is maybe, if I'm correct, like 5, 6, or 7 billion pesos, which is around, I want to say, 90 million US dollars, 100 to 90 to 120 million US dollars. And so I guess it feeds into this level of sophistication. If rich people can't really invest, like you have a portfolio of, let's say, even, you know, 10 or 20 million dollars, it's impossible to liquidate anything. And so I guess that's something that's a lot more prevalent in the Asian markets. And I'd love to hear, alongside what Rayliant strategies are, how do you deal with the problem of liquidity in some of those niche markets?
Also, um, yeah, I'll kind of answer the questions in reverse. Uh, when you are a smaller capital market, Philippine is one. I'm sure there are many. India, despite it being a very large country, large population, and large economy, also actually has a very small capital market, meaning you couldn't unwind $100 million portfolio in that market at all. So not quite as severe as Philippines, but it's the same order of magnitude. The smaller capital markets do not generally attract institutional capital, right? Because if you're talking about big sovereign wealth funds from the Middle East, right? You're talking about pension funds. They simply can't come to these markets because they are a trillion in size, right? How do they deploy their money to invest in the Philippines? And so it becomes a chicken and egg thing, right? Without institutional capital to come in and make your market more efficient, create proper price discovery, supply long-term capital, your market can mature, your companies will have a harder time getting low cost of capital and grow. And even the big companies in your economy might choose to list in the US, right? List in Hong Kong. So that chicken and egg problem is actually quite hard to break away from. And then it is uh, a, a, a big challenge and a difficult one for many emerging markets, stock markets. So that's just the reality, unfair as it may be. Let me kind of segue that from there and say, oh, so what are we doing when Rayliant create products for different markets? So market size matters, unfortunately. So we're generally in the larger market. So we have products in Taiwan, we have products in Japan, we have products in Korea, and of course we have products in Hong Kong and mainland China. These are much larger capital markets when you think about sort of emerging Asia. And specifically, we built out our legacy of asset allocation. So I spoke about that first asset allocation product we did with PIMCO. So we have a range of asset allocation products that are distributed inside China, solving the same problem, right? Because these retail investors also have no idea about diversification. And it's not just diversification by having, 10 stocks, it's diversification across different asset classes, right? Teaching them how to buy gold into the asset allocation portfolio. Now that, different kind of bonds, what do they mean? How do they work inside a model portfolio, large cap versus small cap, different style. So we have asset allocation programs that we roll out, and it's very much, again, connecting to my heritage of these portfolios that I manage by research affiliates. And of course, then extending on the work of Smart Beta, Rob Arnott and I partnered a research affiliate and created basically that methodology. And in China, I've sort of taken it to kind of the 2.0 version, right? We're using machine learning. We're using a lot more factors to construct these smart betas, all because since Rob and I did the original work, there's been a lot of research and there's a lot of improvement on how to do things better. So that is all now part of kind of Rayliant's product offering. So we have a lot of multi-factor with machine learning smart betas that are in China, in Japan, in the format of mutual funds, in the format of ETFs, and also in sort of institutional funds.
What do factors tell us about the market that are, let's call them just tiny human minds can't automatically comprehend by just looking at it, looking at the price, let's say?
Yeah. So, in some ways, factors are almost more informative, right? Because historically, individuals, they look at single stocks. And to understand a single stock is actually far more difficult because there's so many dimensions, right? There's management, right? What is the leadership like? Is the CEO inspirational like a Steve Jobs, or is he, someone who is more operational like a Tim Cook, or is he just, fat and happy sitting on a pile of cash and because he's near retirement, so he doesn't care anymore, right? Like you got to analyze that. Then you got to analyze what industry are they in and what competitive positioning do they have within industry. It's actually significantly harder. Factors are different. And a factor is more macro in nature, and I think it's easier for us to connect to the macro of the world, right? And there are fewer macro things. So the way I explain factors to investors is generally, think of a meal, right? We eat a meal so that we can, grow healthy bodies, right? You have to, absorb nutrients. So when you eat a meal, historically, if you're a chef, right, you think of, like this is a taste of chicken, and what kind of leafy green would taste well with chicken, right? So you're thinking of constructing a meal from like the ingredients perspective, right? Poultry or fish, like leafy green, or like, potato. But actually from a scientific perspective, like modern nutritionists, they don't think about like the taste of chicken, right? That's why they ask you to eat lean turkey all the time, which tastes horrible. What they're thinking protein. Like you want protein, not too much fat. That's not good, right? You want lean protein. And I don't care what leafy green you eat, it's all the same thing, right? It all gives you fiber and the vitamins, right? And seafood gives you omega fatty. That's the good kind of fat. So they look at the nutrients. And that's what factors do, right? When you look at a stock, all the story, all the human elements, the product. Sure, that's interesting, but more scientifically, when you think about what builds a good portfolio that has long-term health, that compounds your wealth more efficiently, you want to look at the nutrients, right? Are you getting your minerals, your vitamin D's, your proteins, your good fat, right? And that's what factors do. They basically say, within your portfolios, do you have these good long-term building blocks for long-term portfolio health? So you look at that, it's actually a more scientific way of thinking about a portfolio.
And going back to the topic of inefficiency in the Asian markets, in the US, obviously factors are described as risk premia. We have momentum or growth or small minus big minus small, or all these different things. And like that's largely been priced in the US because there's been so much academic research on that. All the finance PhDs talk about that. I'm doing a master's in financial engineering, and I mean it's at Columbia. It's been my first week, and I know they've already mentioned capital asset pricing model. So I know we're gonna go in that direction, and I'm looking forward to it. But it seems like everyone kind of knows that in the US. And so I guess your thesis with Rayliant is that because retail investors are a lot less sophisticated, they like to gamble, they like to do the equivalent. Like I remember, I think I was talking to my dad or someone else about this. There was this Filipino gambling stock, and it was just shooting up and up and up. And then they announced that they were gonna ban mobile gambling from this. There's this payment platform called Gcash, and they were gonna make it so you wouldn't be able to transfer money from your Gcash account into this particular gambling app, and the stock tanked, I think 40-50%. And so there's a lot of this urge to gamble. As you said, Asians love saving money, are very, very frugal, and they also love talking about their money, but they they don't like someone really touching their money. It's very much, I want to manage this, and that's the cultural aspect. But I guess I'd love to hear it from you. Do you think that this it's that retail audience that makes it so that factor ETFs, let's say, or smart beta ETFs, rather than providing risk premia, really end up picking up inefficiency? When you say that?
Yes. Ethan, you are spot on. And again, for your audience who are more trained in sort of financial knowledge, factors pick up two sources of returns, and sometimes one factor can pick up both. But the two sources are, one, risk premium, and the other one, sort of behavioral biases. In some sense, behavioral biases is a bit more like the proverbial free lunch, right? And clearly you don't expect a lot of free lunches, and you don't expect them to persist, but they do happen occasionally, right? There's occasionally a $20 bill on the side of the road. Just, you better get to it fast, right? Otherwise, it's not going to stick around forever. So yes, in Asia, there are a lot more behavioral biases, like these free lunches that are driven by propensity for uninformed investors to gamble in the stock market, right? It's like, if you go play poker and you're bad at poker, you're going to lose quite regularly, and the pros are going to be quite happy that you come, right? And in fact, the pros want to go to, casinos with a lot of tourists, right? And so Asia in some ways is kind of like that. So there are a lot of factors that go after these propensity for gambling, these behavioral biases. And in some ways, they are a bit more of a free lunch for the disciplined professional money manager. Now in the US, not a lot of free lunches for obvious reasons, right? Very competitive, and sometimes even the retails, they're almost like semi-professional athletes if they're not full-on athletes, right? So in the U.S., oftentimes these factors pick up risk premium, meaning the factors are constructed to capture different sources of risk that are not obvious, right? Like we kind of go, okay, I understand market risk, right? Like if Donald Trump has another crazy terrified with China, the market will tank. So that is a factor you can understand. But there are lots of other smaller factors that taps on liquidity risk, credit risk, this kind of black swan risk. And so there are other factors that are just meant to efficiently proxy and give you access to different risk in the market, that if you are willing to hold it, you get a higher return, right? Because you are risk sharing with someone. And so two sources of returns when you use factors to access markets: the behavioral, a bit more free lunch, and then the risk base, which is just a more efficient way to risk share with the market, and in return you get a premium.
And so what specific factors does Rayliant use to capture the more free lunch behavioral aspect of that? I'm curious.
So in Asia, I would say governance is really, really useful. And governance basically looks at the quality of the management team. Because in Asia, you're Asian, and so you probably read plenty about companies that are controlled by a family, and either because of family feud and they destroy the company, or the company has set up a lot of wholly owned subsidiary by the family, but they control public company. They're like 20% owner of public company, but 100% owner of the small subsidiary, and there's like wealth transfer from the public's money to their own pocket. So there's things like that happen in Asia more so than, I have to say, in the US. So governance is important, right? Because you weed out those bad operators, and instantly you improve your portfolio return by paying attention to governance, right? Like, is there a high quality management team? Is a good governance structure so they can't steal from small shareholders? Does their accounting look good? There's no red flags to how they do accounting, how they audit themselves. So governance as a factor, or as a category of factors, super useful. And of course, we also look at smart money versus dumb money, right? Because there you can try to figure out whether a stock is largely bought and held by retail, which, sorry, it's a little derogatory. We label as dumb money, or it's mostly owned by long-term pension funds, owned by hedge funds, which are, smarter money. And you just follow the smart money and stay away from what the dumb money is buying. And again, that improves alpha very significantly. Uh, you look at valuation, right? In those markets, like in the US, when you say high valuation, you're thinking about, the tech companies. And these tech companies are expensive, but their growth is also fast. So oftentimes their earnings growth do end up catching up with their, high PE, making it worthwhile. But in Asia, oftentimes when you see something that has a ridiculous PE, it's generally because it's been extremely overhyped and there's like almost a syndicate of like unholy, shady, operators trying to hype up a stock. So valuation actually tells you a lot more about this is overvalued rather than this is high growth. So looking at valuation gives you a different information set in Asia versus the US. So those would be the factors we look at.
I remember, towards the beginning, or maybe, I think, yeah, towards the beginning of our conversation, you talked about how at Rayliant you offer a number of, different factor portfolios and some that utilize machine learning. And I guess, there's a million different ways to apply machine learning in a quant research pipeline. Obviously, you have the HFTs who do it, like really, really like on the milliseconds. And then there's also the, large asset managers or hedge funds that'll do, forecasts for, like longer period, many days in future based off of, I guess, some sort of alternative data. And I am curious, but really, how do you guys implement it?
Because we are, institutional in nature, we deal with pension funds, sovereign wealth funds. There is not just creating return, right? They have a dual mandate of they want the capital to be, to say, to be a source of good, right? They think about capital not as a way to exploit and extract returns from market. They think of capital as I'm supplying capital to entrepreneurs. I'm supplying capital to a good company, and by supporting a good company, I create a good product. By supplying a good entrepreneur with patient capital so he can innovate, right? We are creating value, and I earn a return from helping someone create value. So when you're dealing with pension funds, when you're dealing with sovereign wealth fund, that's how they see capital. They're long-term capital meant to invest, foster, and drive growth. So they tend not to love like high frequency scalping as an activity, because they don't feel like these very fragile high frequency trading is sort of conducive to, entrepreneurial growth, to the growth of good companies. So we are definitely low frequency in our strategy. We definitely focus a lot more on avoiding bubbles so that good capital doesn't go to bad use. Focusing on undervalued companies, basically good ideas, who, because their CEO is not a hype master, right? So they can't get low cost of capital. So we want to be there and be a good cost of capital to support them to grow. So we tend to operate and build models that are more like that. And so lower frequency, much more fundamentally focused, much more kind of growth and value creation focus in how we pick factors to then pick companies.
I find that a lot of, if I talk to any person who I guess works on the buy side, and, does a lot of, does quant research and I guess built, in your case, builds ETFs, but anyone who really just does stuff for, let's say, any sort of stock selection / asset management, the questions I always like to ask are about edge. And so I want to ask you, given your experience in really thinking deeply about market efficiency and, in the US back in 2002 when you started research affiliates, and now when you've spun off with when you now more involved with Rayliant and spinning off the Asia division, how do you think about edge in in the financial markets? And I guess more specifically, do you think that discretionary managers, actually, yeah, do you think discretionary managers in the US can still have edge? And like, given that there's been so much efficiency in the markets recently.
You know, absolutely. Like, when we say, you know, active management in the US has been hard. No one seems to really consistently outperform except for some of the most brilliant minds. It's not a knock against the experience and knowledge, the training of investment managers in the US, right? In some ways, it's to say, look, it's like watching the world poker tournament, right? Only the best of the best sit at the same table and play. And there, you can't predict who's going to win. It's going to be this guy this time, that guy next time. You don't consistently win because everyone you play against are world champions, right? They're the very best. If you were to take that guy and put him at a local casino, they just clean up, right? They beat everyone. And so in the US, it's really a statement about competition. So yes, very few of them have a consistent edge against the competition. It's not because they're not good, it's because the competition is equally good. Okay. So I think it's just really important to remind everyone. Now, our edge, and I would say why our edge is a bit more robust and consistent, even in the US, is the quantitative science is even in the US, right? You could say it's fairly new, right? Because visiting a company, talking to the company's management team, understanding their upstream, middle stream, downstream, understand the industry, right? That art has been practiced since the early 1900s, right? So it's 100 years in the making, if not longer. And so people have gotten super good at it, and the really good people all been trained about the same way. So they just don't have an edge against each other. The quantitative science has only entered the investment world, say, the last 2 decades, right? Before that, it was probably just someone's science project. It's gradually gaining some momentum. It's gaining some assets, but it's still really, the minority when it comes to the style. And that gives you an opportunity, right? Because you don't want to go towards super crowded where the thing's been done for 100 years and everyone knows how to do it, right? So, quant has evolved from simple quant, you building models in Excel to now, of course, like you say, there's high frequency, there's varying frequency, there's using machine learning, which we do, using sophisticated factors, building more sophisticated models, nonlinear models. So I'd say there you're more likely to still have an edge because this field is still young-ish, and the technology is sort of still advancing. So a lot of things that you did before could be done a lot better if you invested the time to understand the technology and incorporate that into your process. But I just can't say that for the traditional sort of buy-side research analyst, right? That art sort of, you know, basically is so mature, right? There's just not much innovation in terms of the methodology anymore.
100%. And I think what you really hit the nail on the head on was with when you talked about the level of sophistication in the competition. I'm listing hedge fund managers in my head. Even a guy like Jim Chanos, who used to be worth, I think, $6-7 billion, one Tesla short, and he's no longer a billionaire. Like, it's ridiculous how even someone who's clearly very exceptional, I mean, to make that amount of money in the markets is ridiculous. And even someone at the top of their game like that can still make errors, or even one might even say he was justified in some of those shorts, but there's an element of luck involved. And so I think that's, yeah, go on, please.
No, absolutely. Right. I mean, you see some of the, again, using a poker analogy, right? Some of the best poker players, they could lose big, right? Like they could make the right bet on a winning hand versus the competition, but someone draws a better card on, on the river, right? What are you gonna do about it, right? So luck plays a big part, And this is where I think uh, systematic strategies, computers do a lot better than humans. Is computers understand probabilities much better than the human with the best sort of probabilistic instinct. Like computer gets it exactly right. So in the case of what you just mentioned, right? Hedge fund managers who make bets that are too big in retrospect, yeah, they're probably well informed. The bet is probably right, but it's the bet sizing that's wrong. It's too big, right? Their edge is not big enough for them to go all in all the time. A computer would stop you. The computer would say, look, probabilistically, you're probably likely right? In this case, your edge is maybe 60% smarter than everyone else when it comes to Tesla. And given your wealth, the right size of Tesla bet should be this, right? So in the 40% where you're wrong or you're right, but prices run away from you in the short run, like you don't get blown out, right? And that is something a computer model do much better for you, right? It's not just about making the right bet, it's sizing it to the right size.
Yeah. I guess the first thing that comes to mind, because we're talking about bet sizing and discretionary investing, I think the guys who've really mastered, well, not really mastered, but built a process to make the most out of discretionary investors, high level are probably the pod guys, your Citadels, your Millenniums. By isolating the alpha and by having an army of pods, you're able to essentially diversify completely across people who are exceptional and can generate great ideas. And I guess, I'd like to hear it from you. Where do you see the future of discretionary portfolio managers? Do you think that capital consolidates to all these top firms, as in my eyes it has been? You look at, and not even just from a fundamental perspective, looking at Citadel or Millennium's AUM or 0.72 for that matter, but even the from a talent perspective in the quant shops. I mean, I saw yesterday or 2 days ago, Jane Street's, was it first quarter revenue or first half of the year's revenue, uh, compared to all the bulge bracket banks, and they, absolutely demolished them, which is ridiculous for a company with, far fewer employees. And so I guess I'd like to hear from you. Where do you see, I guess not just for asset management, but for trading in general, where do you see capital consolidating, and where do you see the future of investment management going in the next couple of years?
Yeah, so I would say this recent rise of these ultra high frequency, call them market makers, call them, high frequency prop trading shops, same difference. That rise has probably gone to its logical end. And this is, I would say, using Elon Musk first principle thinking, right? Uh, the sustainability of a business, of an industry, in the long run, is entirely predicated on the value creation. Okay, so to kind of forecast these, market makers, these high frequency sort of trading shops, you gotta go, well, what is the value they generate for society and the value they're extracting, right? If they're just extracting value, you're not going to stick around very long if you're just extracting values from other people, right? Casino, right? Casino, like, the society tolerates casinos, right? Casinos all make good money, but if you look at casino and what they produce and their aggregate footprint in society, it's tiny, right? It's irrelevant, right? Because all they do is they extract money that someone has already made from other value creation. So if you're just extracting value from someone, chances are this industry, this endeavor can't get very big, right? Because if the entire world was just all of us trying to extract value, well, who's going to create value, right? The bulk of the world is still got to be involved in creating value. So, and if you look at the AUM, the what drives financial markets, you got these bright spots of hedge funds who make a lot of money, but they're ultimately it's not sustainable. It doesn't get very big because the bulk of financial services is services, right? You service people who create value, right? You realize bankers don't do anything particularly useful if you think about things being creative, right? Like, what do you consume from a banker? What do you consume from a portfolio manager? Nothing, right? They don't make the phone, they don't make the computer, right? They don't make your food, right? That's made by someone else. Their job is to service the people who actually do the work, right? Not just take value from the people who do the work, right? That'd be quite bad. So the bulk of the market, the financial industry, right, will continue to be because it offers services, capital to drive useful innovation, to drive production of what we need. So those are ultimately the longer term capital. It's the VC capital that funds the entrepreneurs, right? It's the private equity capital to fund smaller companies that can't get listed. It's the public equities, these mutual funds, these pension funds and the managers they use that fund big companies. That is still going to be mainstream. So like I would say the Citadels, Millenniums, they're a bit of a sideshow. They create some billionaires, but again, if you look at what exactly do they do, right? Other than saying, oh, it's almost like watching a great chess player, super smart, super exciting. They do amazing things. They're super smart. And they get paid for being a great chess player, but that doesn't translate into value for others, unfortunately. And because that doesn't, it can't get very big. It's always going to be a sideshow.
What value are you trying to provide to the world with Rayliant?
I would say what we're trying to do is we're trying to, especially when we're in Asia working with the retail investors, we're trying to take otherwise speculative, short-term uninformed capital that might go fund the wrong company, the bad ideas, that might be too short-term, so it actually funds nothing other than gambling. We're trying to take that through education, put it into funds vehicle, right? Get people away from day trading into longer term investing, and then through factors that focus on governance and growth drivers and value creation that then creates longer term capital that really fund the entrepreneurs, that really fund the business that deliver what we need as society.
I love that. And I think that so often people within the financial sector will think about it and I understand this, but really just treat it as a game of poker. There's all this inefficiency in the market. There are all these different market participants. Look to my right, okay, that's a GameStop guy. That's a Wall Street Bets guy. Look to my left, okay, I have Ken Griffin over here, right? And they look at the arena and they say, okay, I can scoop this up. I can get that. I could take this, take that. But I do think, but fundamentally, we all should be trying to make society better. And I think that the financial sector does that in certain ways and doesn't do that in other ways. And so I love your vision, and I think that that is something that more people in the financial sector should have a mission to do, to really allocate capital to good companies that need it. This is my last question. I think this would be a great way to end the episode, to end the podcast. I'm 21 today, and I'm doing this master's in financial engineering. I'm just moved to New York. And I find that it's very, very difficult to pursue a career in a city like this where you're making a lot of good impact for society while making enough money to support yourself and eventually maybe a family. And, those two things, obviously, that's a contrast. And then further than that, the recruiting pipeline gets harder and harder every year. And so this year, just from experience of my friends and whatnot and myself, the number of applications that entry-level guys have to send out, it's, easily 300, 400, like easily. And a lot of very intelligent people I know from undergrad who were very smart, and I studied mathematics and physics, clearly very smart people, didn't land jobs that I thought were on the level of their intellectual capability. And so I guess it's for young people today. How do you navigate this? Because it feels like you either have to sell out and just go all in and maybe not make the biggest impact, but at the same time, maybe that's not how we want to structure our careers. Maybe that's not what we want to do.
So, yep, you ask a really hard question. And let me take it from this dimension, because I think this might be more useful for you and your listeners. I think a lot of us, and I would say, it's probably particularly true for Asians, is we tend to see our life as phases, right? You know, go to high school and it's about getting into a great college, and then college is about maybe getting into a great grad school, and then grad school is about then getting you to a great job, right? But I recommend, maybe there's another way to look at it, which is it's a continuity. Everything is constantly trying to get you prepared for what is really the world, right? Like, when we're in high school, you're a bit more insulated from the real world. You're from college, slightly less so, and grad school, slightly less so. So it's like easing your way into reality. And so you're probably like just at that last step before reality fully use you and abuse you on a daily basis, okay? So what you're experiencing is not like, oh, this is really hard and I got to get through this to then get to the other side, right? This is just preparing you for what the other side looks like all the time, right? Like the other side looks like what? The other side looks like talented people who want to do hard work don't get matched up with the right opportunity. That is 90% of the time, right? That is reality, right? That is not, oh, this is happening to you as a graduate student, right? That is like, in life, it will happen to you nonstop. What do you do about it? How do you adjust to that? In real life, it's constant rejection, right? Because a lot of good people all want to go after the good opportunities, right? So it's constant rejection, and a lot of times it's not fair, right? Like, because you're equally good. Who gets a job? It's not merit based, it's random, right? Like, it's just like the poker game, right? When it's the best people playing poker, outcome is random. It's kind of weird, right? It's like when the best people are going after jobs, the outcome is random. Don't take that personally. That is reality. That is just life. All right. So what you're experiencing now is a reflection of reality, because you are about to be launched into reality. And reality is hard, right? Like, good, hardworking, highly educated, intelligent people all want the same opportunity, right? So there's a lot of randomness that happens, and that you just deal with that. It's a lot of proving yourself to people who are less good than you are, because they control the opportunity, and it takes a long time for you to cross over to the other side to unlock your potential, right? The world does not owe it to you to unlock your potential for you. The world doesn't owe it to you to give you a good job because you're smart and hardworking and well educated, right? And so what you're experiencing today is about to be 100%, right? You're leaving the simulation, right? This is like 100% of what reality is going to feel like for the next 50 years.
I love that. Thank you so much, Jason. I thought that was a wonderful conversation. I truly learned a lot. All the best.